Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Twilio. So Twilio just reported some results, Q4 results, that really impressed investors. And it was this company that, in the past year, like many of these kind of as a service companies, has been struggling, and it's down approximately 50% from its highs, and it's trading even after the pop after hours. It's probably trading towards the lower end of its 52-week low. Um, and there's a lot here to like about it. They put out very strong guidance, and the stock is priced approximately 10 times forward sales. So I'm just going to go through all that, and hopefully you'll find this helpful. So yeah, as I already alluded to it in the introduction, the stock has just been absolutely battered, and I mean, it's not a clear cut here. So because there's a lot here that kind of puts many investors off. Essentially, it's a business that is growth is highly inorganic, and it causes problems on its bottom line profitability. Um, so let me just kind of get into here, right? So what I particularly like here is the Q1 2022 is pointing towards approximately 47% year-over-year growth. Now, think about this. First, it's the tough comp against the same period a year ago, okay? Secondly, Twilio has consistently argued we have what it takes to grow at approximately 30% organically. And the guidance for Q1 2022 points to 865 million. You can see here the green arrow. Analysts were expecting approximately 800. So it's not that they kind of just a little bit beat estimates to kind of lowball and kind of allow themselves room for maneuver. They just utterly smash this out, that they just gives us, they're so confident that they, even at this stage, they said, okay, analysts are going to have to be upwards revising their guidance. I suspect that in the next several days we're going to see analysts coming out and say, oh, Twilio, great call, this and that, and they're going to be revising their financial models, upping and revising their guidance expectations for the next several quarters, and this is going to do really well since the stock is trading so cheaply right now. Now, one thing that has particularly jarred me with Twilio is that they have this vision, okay? The vision is to allow companies a better way to interact with their own customers. Companies don't really want to have to rely on third-party providers to have a means to interact with their customers. They want a direct contact with their customers. On this, Twilio excels, okay? So it's that ability to provide businesses with a link to their own customers. As more and more companies are developing a direct-to-consumer channel, this really plays well for Twilio, okay? So in this kind of new privacy era, this and where it's difficult for brands to really reach out and contact customers, Twilio offers a way to collect that data, unify it, clean it up, and gives you the ways and means and the tools to contact the customer. So that's really, really strong, right? Now, one thing that I've often said, and this is kind of jars to me, is that follow the customer growth rate. And here you can see active customers were only up 16% year over year to 256,000. So that's kind of like not commensurate with a high growth company. 16% customer adoption curve is really not what you want to see. On the other side of the equation, what I do like very much is to see that dollar-based net retention. Anytime that it hits above 120%, you should kind of like pay attention. And Twilio has consistently reported very strong 130% this past quarter if you exclude the politicals revenues in Q4 last year. So it's, you can see here in the graph, consistently above 120%. So that's really, really strong. Now, one thing that always bothers me about Twilio is that they just can't get that path to profitability. The non-GAAP operating margin was negative 3% compared to positive 2% in the same period a year ago. And this is something that, even if we look out to the next quarter, they're pointing to approximately negative 2% for, well, sorry, let me rephrase. The guidance for next quarter points to approximately negative 3% as well, but they're probably going to lowball in that, and they're going to come around probably in around negative 1%, probably break even, but that's still going to be a step back from where they were the same period a year ago when they were positive 2%. So they're just not getting that traction to leverage that extra revenue that they're booking on the top line. On that front, during the earnings call, they talked about the fact that sorry, let me rephrase. During the pre-prepared remarks, they talked about that starting 2023, they're going to be sustainably profitable on a non-GAAP basis. So yes, you do have to kind of put up with one more year of incurring losses, but they're saying that just be patient. The other thing that kind of is worthwhile noting is that while the top line was up approximately 50% year over year, stock-based compensation is up 75% year over year. So the stock-based compensation is just in tech companies, you kind of don't want to see stock-based compensation meaningfully outgrowing the top line. If you outgrowing the top line, is meaning you're paying the management too much and they're not really giving you a return on investment. So that's something to kind of put out there. All that being contended, it's the stock right now is priced at approximately 10 times forward sales. So if you look here in the graph, you can see that over the past year, it has gone from approximately being priced at approximately 30 times forward sales, and it's now just like compressed really, really significantly. So if you're getting some growth and the growth is so much, they don't give you the growth prospects for the next year, but if you're getting the growth rate to be so strong above what analysts are expecting, I believe that they have what it takes to fulfill their promise or fulfill their guidance that they're going to grow organically at more than 30% over the next 3 years. So all that, I think that it's probably worthwhile considering this investment. Yeah, but if you want to find out what stocks I'm actually buying right now, don't forget to check out my marketplace, okay? It's called Deep Value Returns. Come on board, I give you high quality, actionable investment ideas. Okay, thank you so much. See you soon, bye-bye.